At the end of every accounting period before financial statements can be prepared, adjusting entries need to be made because prior to that you have balances that aren't correct. So you record and post these adjusting entries at the end of the accounting period before the financial statements can be prepared. You'll look at what's called your unadjusted trial balance, which was in a previous slide. See, this unadjusted trial balance is the list of all the accounts in your ledger, and they call them unadjusted balances because they're not quite correct yet. We have to make sure before giving out financial statements that all revenues that have been earned have been recorded and all expenses that have been incurred have been recorded. And there's some that need to be done by the accountants because of these balances changing over time. So after you make these adjusting entries, the result will be you have proper balances on both your, on all your statements actually, not just your income statement and balance sheet. So these adjusting entries that are needed are called accruals and deferrals. Accruals, the idea behind it is that the action comes first. You either earn a revenue or you incur an expense, and then later the cash changes hands. So the two examples of that would be, okay, you earn revenue first and you bill your customer, then later you'll collect the cash. On your balance sheet you'll show accounts receivable, and that explains why these are different. It's because in the meantime, when you record this revenue that's been earned and hasn't yet been collected, you'll debit accounts receivable and credit revenue. Now, as far as expenses go, when you get a service first before you pay, you're going to debit the expense and not credit cash. Cash comes out or gets paid later. What you'll show on your financials are payables on the balance sheet, showing that you've incurred expenses that you haven't yet paid, and later when you pay them you'll reduce your payable and reduce your cash. Now deferrals, it's basically defer means to wait. What happens is that the cash changes hands, but you wait before you record the revenue or the expense. So let's go with revenues. You first collect the money, but you're not allowed to record the revenue until you've earned it. So you wait, and later when it's earned you'll record the revenue. When you get the cash, what you'll be having to credit is your unearned revenue, because you're not allowed to credit the revenue until it's actually earned. So unearned revenue explains the timing difference between when the cash is collected and the revenue is finally recorded. And then for expenses, you pay your money in advance. You pay the money first and then later you use it. So in that case, what you'll see on your balance sheet to explain the difference between the cash paid and the amount you've used during the period, you'd see prepaids or other assets like supplies, and then your equipment and long-term assets that will be used over time. So that's the 4 types of adjusting entries. We'll walk through the specifics of each one in future videos.